Well, we're back with you here, keeping a close eye on your ag commodity trade. And I tell you what, it is kind of a disappointing trade for producers today when you look at what's going on in the grain markets and the livestock trade. Nothing can escape the way it seems here today. A big risk-off day, apparently. Let's go to the corn board and see what they're doing right now, even in spite of the fact that we had an overnight export sale to Mexico. Let's see what corn is doing on the big board. Here we go on December. We're down 3.5 cents right now. That December contract is trading at 478.5, just kind of hovering there, about 1.5 pennies above our low of the day. In soybeans, wow. What can you say about soybeans? 19.5 lower on November, $13.50. We got down to $12.98 about 45 minutes ago. And then it went back above $13 for a little bit, and now it's just trying like heck just to hang on to $13. So it's very tenuous right now. On the wheat trade in Chicago, December 5 3/4 lower. We're at $5.83 per bushel. That's roughly about 3 cents from its low of the day, off our overnight high by 7 cents. Kansas City wheat December down 9 1/4 now at $7.19 3/4. That would put us 2 pennies off of our low of the day. Minneapolis wheat today, December, down 8 1/4. We're at $7.75 1/4 right now. That's only 1 1/4 from its low of the day. And last night we got as high as $7.84 3/4. So we're almost a dime off of that. In cotton, usually the cotton market can hold up its end of the deal here against the grains, and today it can't. December down 58 points. We're at 86.28 per pound over there. This morning we were talking about the strength in the crude oil market, and November now is 76 points higher, or 76 cents higher, at 90.42 per barrel. November, the lead month there, 90.42. Yikes. The U.S. dollar index had been stronger today as well, and it was 400 points higher. Now it's up 182 points. We're at 104.970. I mean, just barely under 105, but close enough for horseshoes. Let's ask Ted Seifried about that. He is with Zaner Ag Hedge in Chicago. So the dollar hovering around 105 there, Ted, that just seems to add another brick to the load here on the grain.
Yeah, absolutely, Marlon. You've got the dollar as strong as it's been in quite some time. But on top of that, look at the S&P market, for example. It's flirting with that low that we had for mid-August. If we break that low, there's not a whole lot of support for the S&P. So you have stock markets looking like they want to roll over. You have that dollar that continues to make new highs. As you said, it's very much a risk-off day. And then you throw in some negative fundamentals there, too. I mean, for soybeans in particular, look at the export sales. Wow, that's really disappointing for this week, right? I mean, this is a week on the calendar that we expect to see 1.5 million, 2 million metric tons of soybeans sold. And that was a shadow of that. We didn't even quite get to 500,000 metric tons sold. And so you wonder why that is. Now, you can argue that there's issues with the river, just like there was this time last year, and that global end users, they don't want to mess around not knowing how the logistics are going to go, whether they will get those beans on time, and so on and so forth. You could say that it's our domestic exporters that are saying, well, we don't know if we'll have the beans in place in time to get these shipments out, so we'll be reluctant to make sales in the short term. But here's the thing about that, Marlon. If China was really worried about the lack of yield or really the lack of production here in the United States, i.e. a big drop in production on that October report, well, they would be aggressively buying further out, because they'd be sitting here saying, well, there might not be enough soybeans to go around later on, so we need to fill our needs for November onward and buy aggressively. And the fact that they're not doing that says one of two things, Marlon. Either they really, really don't believe that we have a problem here with our yields and that we're going to see a smaller production number below what we saw in September from the USDA, or they just simply don't have the demand. And that's a scary thing, because Brazil's not selling a whole lot of beans to China right now. In the meantime, they're selling corn. So, yeah, I don't know. You got to say those bad export sales and a risk-off day. You got beans down next to 20 cents. It's just a heavy day here. And you know, I keep making excuses saying, you know, we got to test technical levels and then maybe we can bounce from there. And, you know, today that's the $13 level. Maybe we can hold the $13 level and bounce from here. But man, the price action's just not really been working out. So, you know, the narrative that you hear on Twitter and everything like that, unfortunately, you got to listen to the market maybe more than you listen to social media.
And Another thing that, just to go along with what you were talking about there, the thing that's concerning is China has successfully squirreled away the majority, at least I think more than anyone else, the majority of the globe's soybeans, the wheat, the crude oil, and precious metals too. They're just sitting on all of that. So that is a bit of a concern when it comes to all the other countries out there.
Orders, Marlon, and it makes you wonder why. What are they preparing for? Is the question.
Yes. All right, Ted, we'll come back in just a moment. We'll talk about our livestock trade right after this. A lot of minus signs on the grain trade, and to be honest, we have a lot of minus signs on the livestock trade too. Here we go on live cattle. Our quotes are from Bar Chart, and we have October down $1.30. December live cattle sinking by $1.37. We're now at $190.15, only 15 cents from our low of the range there. On feeder cattle today, despite a lower corn market, October is down $2.22. $258.35 is now the last trade. That means we are $2 and a dime off of our earlier high today. Lean hogs, here you have the December contract down $2.62 at $75.60. Let's go back to Ted Seifried. Ted, someone has to throw something in the ag commodities, a lifeline here.
Yes. Let's go back to the whole risk-off day we were talking about, right? I mean, the S&P holding on by just 1 point, the low that it has from August. And again, there's a lot of thin trade below that. We are already below some very major moving average. That's going to give you some sell signals, give your technicians sell signals in the S&P that strengthen the dollar. All of that's really piling up on top of the livestock in general. We talked about it on Tuesday. It's disconcerting when you have corn down and also feeder cattle down fairly sharply. It really kind of tells you that we have macroeconomic things at play here. And that's very much the case here today. There's a lot of fear and concern about this stock market rolling over and going into some scary territory, going to fall into winter, slowdown in the economy, people not wanting to spend as much money, and therefore your more expensive cuts of beef, which have been hovering at rather high prices for quite some time, come under fire. Now, the one that I'm a little bit curious about is pork. First of all, our pork exports picked up pretty well last week after a kind of a one-off event the week before. And you can say that maybe pork would be a substitute. Maybe we would see more pork demand in a situation where we have stock market fear, 401k fear, people wanting to spend less money at the grocer. Maybe they move to pork from the higher cuts of beef. So I wonder if pork maybe catches a bid here at some point based on this risk off.
Interesting. Very interesting.
But not so far today.
Not so far. That's right. Well, I'm glad you brought that up. Thanks, Ted. Great talking points, and we'll catch up with you here real soon. Ted Seifried of Zaner Ag Hedge with us here on a very busy Thursday morning, at least for the Bears, Tammy.